Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we're embarking on a really crucial deep dive. It sits right where fundamental physics meets, high-stakes global investment. We're digging into two defining trends, big ones, shaping technology and geopolitics for, the next decade at least.
That's absolutely right. Our first theme is this fierce global tech race, specifically the battle for quantum computing dominance. And we're looking beyond just U.S. big tech here, focusing on how a European champion, IQM, is really carving out a serious challenge against Google, IBM, the usual suspects.
Okay, yeah, IQM. And the second theme?
That's the massive strategic shift happening right now in China, the world's second largest economy. They're officially moving away from just chasing pure speed, quantity of output. Now the focus is demanding quality. High-tech self-sufficiency is a huge pivot.
Right. So our mission here is to take all this complex tech, the geopolitics, and just break it down. Make it clear, give you some actionable insights. For you, the learner.
Okay, let's jump into quantum first. Usually when we talk about this stuff, this revolutionary tech, the conversation kind of starts and ends with big tech in America, right?
Typically.
But reports over the past year or so, they seem to indicate Europe is making a really powerful play through this Finnish company, IQM. So what makes them stand out? I mean, it's such an expensive, super specialized field.
Well, what's really interesting here is their approach. It's very pragmatic, especially regarding integration. Instead of, waiting for their hardware to be the ultimate replacement for supercomputers, which is way down the line, they're making it a highly specialized companion. Yeah. And our sources indicate a major milestone was hit pretty recently. IQM successfully integrated its system with NVIDIA's CUDA quantum platform.
Okay, NVIDIA CUDA quantum. So they launched this hybrid HPC quantum solution. Can you break that down? What does that actually mean in practice?
Put simply, it means they're squeezing out maximum efficiency, combining the best of both worlds. They're essentially making the quantum machine a hyper-specialized accelerator within the existing high-performance computing setup, HPC. So you use the classic supercomputing power, those massive NVIDIA GPUs running today's AI for all the routine calculations, and then you send only the really, really complex, the optimized parts of the problem over to the quantum processor. It's fundamentally an efficiency play.
Got it. So it's not replacing, it's enhancing.
Yeah.
And it's not just about industry partnerships, right? There's government backing too. We see Europe using IQM almost like a strategic asset.
Precisely. Yeah. The data reveals IQM was picked as a core partner for the EU's next-gen supercomputer project. It's called LUMI-Q, and it's based in Finland. This commitment, it signals the EU is deadly serious about achieving technological autonomy. Real sovereignty in this space.
So this isn't just VCs throwing money around.
No. This is strategic. It's about building an independent quantum ecosystem, reducing that reliance on American tech giants for what they see as critical future infrastructure.
Okay. Now let's talk about their main competitive weapon, really. It defines their whole business model, the on-premise approach. You mentioned Google, IBM. They offer quantum access, but strictly through the cloud, right? How does IQM's on-premise model differ?
It's all about physical location and, crucially, control. With cloud quantum, you're sending your data, sometimes highly sensitive data, over the internet to a shared data center. Highly secure, yes, but still shared.
Right.
IQM, though, their system is designed so they install the entire physical quantum computer, the actual hardware, the machine itself, directly inside the client's own locked data center. That's what on-premise means.
Okay, that distinction sounds really critical, especially for certain customers. I mean, if cloud access is like renting a super secure room in a shared skyscraper, why would a client need to, own the entire building, metaphorically speaking?
Well, it hits two absolutely vital needs that certain big organizations, they just refuse to compromise on. First, security, with capital S.
Okay.
Think about defense contractors, national security agencies, pharmaceutical companies doing super proprietary drug discovery. They will absolutely refuse, regardless of cost, to send their most sensitive crown jewels over a public network to some third-party cloud. It's just not happening.
So for them, on-premise isn't a nice to have.
It's the only viable path, period.
And you said there were two needs. What's the second?
Integration, like we touched on with the hybrid approach, physical proximity, having the machines right next to each other, it just allows for optimal integration. When your quantum system is sitting right there next to your existing HPC supercomputers, you maximize the combined performance. And you eliminate that network latency, the lag that you'd inevitably get if you had to stream data back and forth to a cloud facility maybe halfway across the country.
Right. Physics still matters. Okay, that makes the tech clear. But let's transition that into investment strategy. Because quantum computing, it's what we call deep tech. It's expensive, it's revolutionary, and crucially, it's not going to generate short-term profits, is it?
That is probably the single most important takeaway for any investor looking at this space. The data absolutely confirms it. You must adopt like a 10-year minimum, a really long-term perspective.
10 years minimum, wow.
Yeah. I mean, IQM, IonQ, others, they are making breakthroughs. We're starting to see the first potential applications, new materials, maybe drug design. But mass profitability, widespread commercial return, that's still realistically a decade, maybe more. And the capital needed is just immense. Look at IQM, they raised something like $600 million just to stay competitive.
Okay, so given that timeline and the pretty high risk of betting on any single hardware winner, how does an investor position themselves today? This sounds like where we apply that famous pick and shovel strategy.
Indeed. Exactly. The gold rush analogy holds up pretty well here. Don't just bet heavily on who finds the quantum gold, whether it's IQM or IBM or Google. Instead, bet on the companies selling the essential tools, the picks and shovels needed by everyone who's digging.
Right, because they all need certain basic things.
Exactly. And since all the big players are using different underlying quantum technologies, superconducting circuits, trapped ions, photonics, it's a whole zoo. The smart investment often lies in the common infrastructure, the stuff they all rely on.
So what are those common tools? We identified, 3 key areas?
Yeah, 3 main buckets. First, core components and materials. This means the crucial technology-agnostic parts. Think companies specializing in ultra-low temperature cooling systems. These things run incredibly cold. Or specialized measuring and control equipment. High-purity materials like specific superconductors. Every quantum computer, regardless of type, needs these fundamental building blocks.
Okay, components and materials. And second, you mentioned focusing on software.
That's right. Software and algorithms. Look, the hardware is amazing, but it's useless if only like a handful of PhD physicists can actually program it.
Good point.
So investment needs to flow into companies building user-friendly Sci4 stacks, development kits, SDKs, specialized algorithms, stuff that allows everyday engineers and data scientists, the non-PhDs, to actually use these powerful machines. Dominance through the software ecosystem is just as vital, maybe more vital long-term than just hardware dominance.
Makes sense. Usability is key. And the third area, which you hinted, is maybe the most immediate opportunity for actual revenue today, post-quantum cryptography.
Yes, quantum security, or PQC as it's known. This is basically the critical software upgrade the entire world needs, and needs it like right now. Yeah. The big fear, the known threat, is that once a powerful, fault-tolerant quantum computer gets built, it'll break standard encryption, like RSA, the stuff protecting almost everything online today. Instantly.
Compromising decades of stored data.
Wow.
Okay, yeah. Everything from bank records to government secrets. So why is this an immediate revenue generator, unlike the quantum hardware itself?
Because organizations think banks, governments, critical infrastructure providers, they simply can't wait a decade for that quantum threat to fully materialize. It's too late then. They need to start transitioning their security infrastructure to these new PQC standards today. Like yesterday, really.
So investing in P2C firms is like?
It's essentially investing in a necessary global software patch. It provides immediate, potentially very defensible revenue, while the rest of the quantum hardware field is still waiting for that big breakthrough moment.
Okay, that definitely provides a much-needed hedge or maybe a different risk profile compared to the pure-play specialist firms like IQM or IonQ.
Exactly. You compare that high-risk, high-reward of the specialist hardware firms, where success could mean huge returns, but failure could mean, well, total capital depletion. Compare that to big tech like Google or IBM. They offer stability from their other massive revenue streams. But even if their quantum division succeeds, it's a relatively small part of their overall market cap. The upside is diluted. PQC offers this sort of medium-term, high-utility play that kind of bridges that gap. Real need, real revenue, sooner rather than later.
Okay, let's shift gears completely now. We're moving from the microscopic world of qubits to the the huge macroeconomic shifts in the world's second-largest economy, China's strategic pivot.
Yeah, this is major. Recent analyses, particularly looking at outputs from the 20th Party Central Committee's fourth plenary session, they confirm a colossal strategic shift, a really fundamental change. China has officially abandoned high-speed growth, that quantity-driven GDP at all costs era, and they've replaced it with a national priority on qualitative growth. And crucially, building what they call a modern industrial system.
So this means the old model, the World Factory 1.0, just churning out cheap stuff in massive quantities, that's officially over.
It's the official beginning of World's Factory 2.0. This new era, it's all centered on high-tech manufacturing. Output fueled by robotics, advanced processes, sophisticated AI. They recognize that the old low-cost manufacturing model, well, it's just not sustainable long-term. And it's strategically vulnerable, especially with current geopolitics.
Right. And their primary strategic focus, this new productivity idea, it heavily emphasizes advanced manufacturing, which is where they believe they can compete more realistically against the U.S., maybe.
That seems to be the calculation.
What's the unique competitive edge they think they have here?
Well, while the U.S. currently leads in what you might call generalized AI, I think large language models, chatbots, that sort of thing, the reports really highlight China's unique and, frankly, massive advantage: the sheer unbelievable volume of industrial data.
Industrial data.
Yeah, data generated by its gigantic, sprawling manufacturing sector. Decades of it. Sensor data, process data, logistics data, just oceans of it.
So the modern industrial system isn't just about building fancier factories. It's a national strategy to feed all that manufacturing data into their own proprietary AI systems.
Absolutely. That's the core idea. The U.S. might have better generalized AI for now, but China has vastly more, and arguably better, data for industrial optimization. They're using AI to learn from and optimize everything: factory floors, logistics chains, supply components, fundamentally improving the quality and efficiency of their output. It's kind of the difference between using AI to write a poem versus using AI to optimize a microchip production line. Very different applications, very different data needs.
And we see the urgency in this, right?
Mhm.
Especially in the talent war for semiconductors.
Oh, definitely. The reports confirm this urgency. Aggressive talent poaching, especially in cutting-edge memory tech. We're talking HBM, high bandwidth memory, and 3D NAND. These are those highly advanced, stacked memory chips, absolutely essential for running complex AI models efficiently.
And the offers are significant.
Packages being offered to key foreign engineers. Reports suggest anywhere from 4 to 10 times their original salary, plus housing and other perks.
Wow. Imagine getting an offer 10 times your salary just to, move across the street. That really illustrates the extreme urgency. It's a no-expense-spared approach to achieving technological self-sufficiency.
It signals an all-out national effort. They clearly view control over advanced semiconductor manufacturing as a core national security issue now, not just an economic one.
Okay, this brings us pretty directly to the investment implications. The unavoidable ones, really stemming from this ongoing tech Cold War. Now, we did see some immediate, maybe good news recently. President Trump and Xi Jinping agreed to a one-year trade truce at the APEC summit. That delayed the most catastrophic measures, like those threatened 100% tariffs.
That truce is definitely important. It buys some breathing room. But investors really must exercise extreme caution here. Don't misinterpret it. It is merely buying time. That's the key for us. The core U.S. controls, those restrictions on exporting high-end semiconductor tech and AI capabilities to China, they remain firmly in place, unchanged. So this is strategic breathing room. It is absolutely not a de-escalation of the underlying technological conflict. Investors shouldn't mistake a temporary pause on tariffs for, safety in these critical tech sectors.
Got it. So if the tech war is fundamentally here to stay, maybe just evolving, how must investors approach a market as vast and, frankly, as conflicted as China right now?
Well, the core insight, the big takeaway, is that the historical investment model, just betting on broad Chinese growth, it really no longer applies. Not safely, anyway. You absolutely have to segment the Chinese market. Break it down into two distinct areas. We call this the two Chinas investment strategy.
Two Chinas. Okay, let's start with the cautious side.
Yeah.
Old China. What falls into that bucket?
Old China is basically all the industries that were reliant on that past quantitative growth model, the GDP chasing era. So think real estate, especially the overbuilt parts. Excess infrastructure capacity, think ghost cities, underused ports, low-end consumer goods manufacturing facing margin pressure. These sectors face pretty significant structural decline, headwinds, and should probably be approached with extreme caution, maybe avoided altogether by many.
Okay, that's old China. Tread carefully. And new China. This is where the policy support is concentrated.
Exactly. New China is where the government is actively pouring resources, directing capital, offering incentives, directly supporting those qualitative growth mandates we talked about. So this includes things like semiconductor localization, trying to build their own chip industry, industrial robotics and advanced manufacturing automation, industrial AI, leveraging that data advantage, and specialized biotech. Essentially, investment dollars should follow the policy support, follow the money into these clearly defined strategic sectors.
And since you emphasize China's unique edge being that vast manufacturing data, where should an investor look for those, maybe hidden champions with industrial AI specifically, not the consumer stuff?
Yeah, the focus should be strictly B2B, business-to-business industrial AI firms. Look past the companies just trying to mimic ChatGPT for Chinese consumers. The real unique opportunity probably lies with those specializing in smart factory solutions, supply chain logistics optimization, deep manufacturing process analysis. These are the companies capitalizing on that unique industrial data moat, creating operational efficiencies that, frankly, the U.S. manufacturing base, just due to scale differences, can't easily match in terms of data volume to learn from.
Okay. Finally, let's quickly touch on valuation. Because of all the geopolitical risk, the fears over the old China structural collapse, Chinese stocks broadly are sitting at historically low valuations, aren't they?
They are. Very low by historical standards. And this creates a really fascinating high-risk, high-reward scenario. If, and it's still an if, but if this new China strategy starts showing tangible results, let's say they actually meet some critical semiconductor self-sufficiency goals in the next few years, then the market could dramatically re-rate these specialized high-tech assets. The successful ones, anyway.
So while the risk is definitely still high,
the potential for a multifold valuation rebound in those successful new China sectors is significant. It's definitely something for risk-tolerant investors to watch closely.
Okay, so to quickly recap our deep dive today, for quantum investing, you really need to adopt a long-term, like 10-year plus pick-and-shovel strategy. Prioritize those technology-agnostic components, the enabling tech, and for more immediate potential revenue, look hard at post-quantum cryptography, PQC. And then globally, the most essential investment frame for China, the second largest economy, has shifted immediately. It's moving from old China caution there to new China, investing alongside the government's big push for technological quality and self-sufficiency.
Precisely. And maybe here's a final provocative thought for you, for everyone listening to kind of chew on. The U.S. and China, they seem to be fighting over two different types of AI dominance, right? Generalized AI, like language models, versus industrial AI built on factory data. So given China's massive existing manufacturing base, that huge data advantage, what concrete steps must the U.S. take, maybe even just in the next year, to avoid falling behind in this global race for industrial AI dominance? Specifically, how does it rebuild or enhance its own manufacturing base to generate the competitive data needed? Something to think about.
Definitely something to think about. Don't forget to subscribe and hit that like button.